Imagine waking up tomorrow and discovering your country hasn't been attacked. No missiles, no tanks, no soldiers crossing the border. The factories are still there. The ports are still operating. The banks are still open. And yet, somehow, companies can no longer get paid. Imports begin to stall. Businesses start to panic. Within months, the economy is struggling to breathe. Not because it ran out of money, but because it lost access. Access to a financial network so important that being disconnected from it has been compared to economic exile. Most people have never heard of it. Yet entire countries fear it. Banks obey it. And governments use it as a weapon. It's called SWIFT. And its story reveals something uncomfortable about how power really works in the modern world. Because today, the most powerful weapon may not be a missile. It may be a message that never arrives. At first glance, this looks like a story about banking. It's not. It's a story about permission. Because modern economies don't run on money alone. They run on access. A country can have oil, factories, ports, customers, even billions of dollars. But if it loses access to the networks that connect it to the rest of the world, all that wealth becomes much harder to use. And that's where this story gets interesting. Because over the past few decades, the United States didn't just build the world's largest economy, it became deeply embedded inside the infrastructure that allows the global economy to function. The currency, the payment networks, the clearing systems, the financial plumbing. Which raises a fascinating question. How did a banking messaging system headquartered in Belgium become one of the most powerful tools of American influence? To answer that, we need to understand how money really moves around the world. Today, sending money across the world feels almost effortless. A few clicks, a confirmation message, done. But international banking wasn't always that simple. In fact, for much of the 20th century, moving money across borders was a slow, messy, and surprisingly fragile process. Back then, banks communicated using a system called telex. Think of it as a financial telegraph. Banks would send payment instructions as written messages across communication lines. The problem? Every bank had its own formats, its own procedures, its own way of describing transactions. A single mistake could create a nightmare. One missing digit, one misunderstood instruction, one typo in an account number, and suddenly a large payment might end up delayed, disputed, or sent to the wrong destination. As global trade expanded after World War II, the problem became impossible to ignore. The world economy was growing. International business was exploding. More countries were trading with each other than ever before. Yet the financial infrastructure underneath it still looked like something from a previous era. Imagine trying to run modern air traffic control using handwritten notes and telephone calls. Eventually, something was going to break. Banks knew it, governments knew it, everyone knew it. The world needed a common language, a universal communication system that every bank could understand. Something faster, something safer, something standardized. And in the early 1970s, a group of international banks decided to build exactly that. Not as a weapon, not as a geopolitical tool, just as a practical solution to a growing problem, a way to make global finance work. What they didn't realize was that this simple messaging network would eventually become one of the most important pieces of infrastructure on Earth. And once the world became dependent on it, the real story began. When SWIFT was created in 1973, nobody thought they were building a geopolitical weapon. They thought they were building plumbing. Financial plumbing. The founders had a simple goal: replace the outdated telex system with a faster, more reliable way for banks to communicate. That's it. No grand strategy, no secret plan for global dominance. Just a better way to send banking instructions. And at first, that's exactly what SWIFT was. A useful tool, nothing more. But infrastructure has a strange habit. The more useful it becomes, the harder it becomes to live without. A new bank joins the network, then another, then another. Every new member makes the system more valuable for everyone already inside it. Economists call this a network effect. But let's use a simpler example. Imagine being the first person with a telephone. It's not very useful. There is nobody to call. Now imagine 1 million people have telephones. Suddenly not having one becomes a problem. The value isn't the device itself. The value is being connected to everyone else. SWIFT followed exactly the same path. As more banks joined, more transactions flowed through the network. As more transactions flowed through the network, more banks felt compelled to join. The cycle fed itself, year after year, decade after decade. Eventually, SWIFT stopped being merely a banking service. It became infrastructure, the kind of infrastructure nobody notices until it disappears, like electricity, or the internet, or running water. Today, more than 11,000 financial institutions across more than 200 countries use the network. Every day, tens of millions of messages travel through its systems. Messages authorizing payments, messages confirming trades, messages coordinating the movement of trillions of dollars around the world. And here's the important part. No government forced banks to use SWIFT. No empire imposed it. The network became dominant because it worked, because everyone trusted it, because everyone else was already using it. This is what I call infrastructure gravity. Once enough people depend on a system, alternatives become incredibly difficult to build. Not because they're impossible, because they're lonely. Imagine creating a brand new social network tomorrow. The technology might be excellent, the design might be superior, the security might be better, but if none of your friends are there, what happens? You go back to where everyone already is. The same logic applies to global finance. A rival network isn't competing against SWIFT's technology. It's competing against SWIFT's relationships, its trust, its history, its enormous installed base, and that is a much harder battle to win. By the early 21st century, SWIFT had become something extraordinary. A system so deeply embedded in global commerce that entire economies depended on it without even thinking about it. Which sounds like a success story, and it was. But hidden inside that success was a new reality. When one network becomes indispensable, whoever gains influence over that network gains influence over the world connected to it. And that's where things start to get interesting. Because the biggest misunderstanding about SWIFT is that people think it moves money. It doesn't. Not a single dollar, not 1 cent. And once you understand that, you'll understand where the real power actually lives. Ask almost anyone what SWIFT does, and you'll usually hear the same answer. It moves money around the world. Sounds reasonable. It's also wrong. SWIFT doesn't move money. Not a dollar, not a euro, not a UN, not a single cent. What SWIFT moves is information, and that distinction changes everything. Let's say a company in Egypt wants to pay a supplier in China. Most people imagine money somehow traveling from one bank account to another, crossing oceans, passing through cables, flying around the world. But that's not what happens. The money itself never takes a journey. Instead, banks update their own ledgers. Numbers go down in one place, numbers go up somewhere else. What makes this possible is communication. One bank needs to tell another bank exactly what to do. Who is paying? Who is receiving? How much is being transferred? Which currency is involved? And when the payment should be settled. That's the job of SWIFT. Think of it this way. Imagine 2 warehouses on opposite sides of the planet. Nothing moves until instructions arrive. SWIFT is the instruction sheet. The warehouses are the banks. Without instructions, nobody knows what to load, what to unload, or where anything is supposed to go. The entire system freezes, and this is precisely why SWIFT became so important. Not because it holds money, because it coordinates trust. Every day, millions of financial messages travel through the network. Payment orders, trade confirmations, foreign exchange transactions, investment settlements. The financial system is essentially having a non-stop conversation with itself. SWIFT became the language everyone agreed to speak. And once everyone speaks the same language, something remarkable happens. Transactions become faster, cheaper, more reliable. Global commerce expands, the system becomes stronger. But there's another consequence. When one network becomes responsible for carrying a huge percentage of the world's financial instructions, it starts to accumulate something even more valuable than money. Information. Lots of information. Who is paying whom? Which banks are connected? Which countries trade with each other? Where money is flowing? Where it is not? In other words, SWIFT became more than a messaging system. It became a map, a live map of global financial activity. And that map would eventually become incredibly valuable, because if information is power, then seeing the world's financial traffic is a very powerful position to occupy. But here's the catch. Even with all that information, SWIFT still cannot stop a payment. It can transmit a message, it can record a message, it can route a message, but it cannot settle the transaction itself. For that, you need another layer of the system, a layer most people have never heard of, a layer where the money actually gets cleared, a layer where American influence becomes much harder to avoid. And that layer begins with a simple question. Why does nearly every international transaction eventually lead back to the same currency? At this point, SWIFT sounds important, and it is. But SWIFT alone doesn't explain why the United States holds so much influence over global finance. To understand that, we need to follow a payment. Let's keep it simple. Imagine a company in Egypt wants to buy machinery from a company in China. Neither company is American. Neither bank is American. The goods never touch American soil. So the obvious question is, what does the United States have to do with any of this? More than you might think. Because before the payment can happen, both sides need to agree on one thing: the currency. And that's where the story changes. The Egyptian company doesn't want Chinese yuan. The Chinese supplier doesn't want Egyptian pounds. So both sides choose a third option, the same option used millions of times every day: the US dollar. Now, at first glance, that seems perfectly normal. We've all grown up in a world where international trade is quoted in dollars. Oil is priced in dollars. Many commodities are priced in dollars. A huge share of global trade is invoiced in dollars, so we barely notice it. But stop and think about how strange that really is. Two companies, two countries, neither American, yet both agree to use a currency created by the United States. That's not an accident. That's the result of decades of financial gravity. The dollar became dominant because it was trusted. Then it became trusted because it was dominant. And once that cycle started, it fed itself. The more people used dollars, the more useful dollars became. The more useful dollars became, the more people felt compelled to use them. It's what I call the dollar trap. Nobody is forced into it, at least not directly. The system simply becomes so convenient that leaving it feels expensive. Imagine everyone in the world suddenly agreed to drive on the right side of the road. You could decide to drive on the left. Nobody would stop you. But good luck getting anywhere. The same logic applies to global trade. If your suppliers use dollars, your customers use dollars, your lenders use dollars, your trading partners use dollars, then eventually you use dollars too. Because everyone else already does. And this is where America's influence begins to expand beyond its borders. Because the moment a transaction is denominated in dollars, it enters a financial ecosystem that the United States helped build, regulates, and ultimately oversees. Not necessarily because America owns the transaction, but because America owns much of the infrastructure surrounding the transaction, the roads, the rails, the plumbing, and once a payment enters that ecosystem, it doesn't simply need a message, it needs a way to be completed. It needs banks willing to stand between the sender and the receiver. Banks willing to guarantee that the money actually arrives. Which brings us to one of the least understood parts of global finance, the invisible middlemen. The institutions sitting quietly between thousands of banks around the world. Institutions that most people never see. Yet without them, much of international trade would stop tomorrow. Here's where international finance starts to look less like a payment system and more like an airline network. Imagine you want to fly from a small city in Egypt to a smaller city in China. There probably isn't a direct flight. You'll stop somewhere in between, maybe Dubai, maybe Istanbul, maybe Frankfurt. The global banking system works in a surprisingly similar way. Most banks don't have direct relationships with every other bank on earth. That would be impossible. There are simply too many of them. So instead, banks rely on intermediaries, financial middlemen known as correspondent banks. Let's go back to our Egyptian company buying machinery from China. The Egyptian bank receives the payment order. Then it asks a simple question. Do we have a direct relationship with the Chinese bank? Most of the time, the answer is no. So the bank turns to its correspondent bank, a larger institution that maintains relationships across the global financial system. The correspondent bank acts like a trusted intermediary, a financial translator, a traffic controller, a middleman connecting institutions that otherwise couldn't easily connect themselves. And for decades, this system worked remarkably well. It allowed banks in almost any country to reach banks in almost any other country, even if they had never done business together before. But here's where things become interesting. Because when banks around the world needed correspondent banks for dollar transactions, they naturally gravitated toward the biggest, safest, and most liquid financial institutions. And those institutions were overwhelmingly American. Citibank, JP Morgan, Bank of America, Wells Fargo, and other major players operating under US jurisdiction. Little by little, the center of gravity moved toward the United States. Not because Washington ordered it, because the market rewarded it. The dollar dominated trade, American banks dominated dollar clearing, and everyone followed the path of least resistance. Now think about what that means. A company in Egypt pays a supplier in China. Neither party is American, yet somewhere along the chain, an American correspondent bank may still be involved. The transaction quietly touches infrastructure that falls under US oversight. The payment enters a system where American rules apply, American compliance standards apply, American sanctions apply, and suddenly a transaction between two foreign companies isn't entirely foreign anymore. It's connected to a network that runs through the United States. This is the moment where America's role changes. It stops being just another participant in global finance and starts becoming a gatekeeper. Because gatekeepers don't need to own the road, they only need to control the bridge. And once enough traffic flows through that bridge, everyone crossing it becomes subject to the same rules. This is why banks around the world spend enormous amounts of money on compliance. Not because they enjoy paperwork. Nobody enjoys paperwork, not even bankers. Especially bankers. They do it because losing access to these correspondent relationships can be catastrophic. A bank can survive many things: bad quarters, market downturns, even scandals. What it struggles to survive is isolation, being cut off from the networks that connect it to the rest of the financial world. And that brings us to a hidden institution that almost nobody talks about. An institution more important than SWIFT itself when it comes to moving dollars. A system sitting quietly behind the scenes, clearing trillions of dollars every single day. A system that reveals where the real power of American finance actually resides. It's called CHIPS. And despite the name, it has nothing to do with computers or potato chips. By now, it might seem like SWIFT is the center of everything. The network that keeps global finance alive. The network governments fear losing access to. The network banks cannot live without. And all of that is true. But here's the twist. SWIFT is only the messenger. The real question is, who actually settles the money? Because sending instructions and completing a transaction are two very different things. Imagine ordering a package online. The confirmation email is important. But the email isn't what delivers the package. Something else does the actual work. The same principle applies to international finance, and when it comes to dollar transactions, that work is performed by a system most people have never heard of. CHIPS. The Clearinghouse Interbank Payment System. Not exactly a name that inspires fear. It sounds more like a snack company than one of the pillars of global finance. Yet every day, CHIPS clears trillions of dollars worth of transactions. Quietly, efficiently, almost completely outside public attention. Here's how it works. Let's say Bank A owes Bank B $10 billion. At the same time, Bank B owes Bank A $9 billion. Most people imagine both payments being made separately. 10 billion one way, 9 billion the other. But that would be incredibly inefficient. Instead, CHIPS does something clever. It calculates the difference. Only $1 billion actually needs to move. This process, called netting, dramatically reduces the amount of money required to keep the system functioning. And it allows enormous volumes of transactions to be settled with remarkable efficiency. The result? Trillions of dollars move through the system every day. Yet only a fraction of that amount actually changes hands. It's one of the reasons modern finance can operate at such a massive scale. But here's where things become important. CHIPS isn't a global organization. It is a US-based system, built around the dollar, governed under American law. And if you want to settle dollar payments at scale, there is a very good chance you'll encounter it somewhere along the journey. In other words, the world's dominant currency ultimately relies on infrastructure located inside the world's most powerful economy. Now, the pieces start coming together. The dollar dominates global trade. Correspondent banks connect institutions across borders. CHIPS settles a huge share of dollar transactions. And much of this infrastructure sits under US jurisdiction. This is why American financial power is so different from traditional power. The United States doesn't need to participate in every transaction. It doesn't need to own every bank. It doesn't need to control every economy, because the infrastructure itself creates leverage. Think of it like a highway system. If most of the world's trade passes through roads you supervise, you don't need to sit inside every truck. You only need the ability to stop traffic when necessary. And that ability changes behavior. Banks know it, governments know it, companies know it, which is why compliance with American financial rules often extends far beyond America's borders. Not because everyone agrees with those rules, but because losing access to the infrastructure can be enormously expensive. And that brings us to the most controversial part of the story. Because controlling infrastructure is one thing. Seeing what flows through it is another. For years, most people assumed international financial transactions were largely private. That assumption turned out to be far more complicated than anyone imagined. Especially after a certain event in September 2001 changed the rules of the game forever. For most of its history, SWIFT was viewed as something boring, a technical network, financial plumbing, the kind of infrastructure nobody thinks about. Then came September 11th, 2001, and suddenly governments around the world began looking at financial data very differently. Because investigators discovered something important. Terrorist networks don't just move people, they move money. And if you can follow the money, you can often find the network behind it. That idea would change global finance forever. In the years that followed, American authorities pushed for greater visibility into international financial transactions. The argument was straightforward. If terrorists, criminals, and sanctioned organizations rely on the global financial system, then monitoring financial flows becomes a national security issue. Many governments accepted that logic. Others were less comfortable. Because there was an obvious problem. The same system that could help track criminals could also reveal an extraordinary amount of information about ordinary international transactions. And SWIFT happened to sit in the middle of an enormous portion of those transactions. Remember what we learned earlier. SWIFT doesn't move money, it moves information, but information can be just as valuable, sometimes more valuable. Think about it. If you could see a live map of global financial activity, you would learn a lot. Which countries are trading with each other? Which banks are connected? Which companies are moving money? Which regions are becoming more active? Where capital is flowing and where it is suddenly disappearing? You wouldn't just be observing transactions, you'd be observing the circulation system of the global economy itself. What emerged after 9/11 was something I like to call financial radar, the ability to observe large parts of global financial traffic as it moves through the system. Not every transaction, not a magical screen showing everything happening everywhere, but enough visibility to create a powerful intelligence advantage. And this is where many people misunderstand the nature of modern financial power. They imagine sanctions begin when a government decides to punish someone. But sanctions are only effective if you know who to target. You need visibility before you can apply pressure. You need information before you can enforce rules. And over time, the combination of SWIFT data, banking compliance requirements, correspondent banking records, and dollar clearing infrastructure gave American authorities something no other country possessed at the same scale. Awareness. The ability to see patterns, relationships, connections, financial behavior. Not because America controlled every bank, but because so much of the world's financial activity eventually touched systems that America could influence, regulate, or access through legal mechanisms. And once you can see enough of the board, you become much better at playing the game. Which brings us to the moment when financial infrastructure stopped being merely infrastructure and became a weapon. Because seeing a transaction is one thing, stopping it is another. And over the last 2 decades, the world has repeatedly discovered what happens when access to the financial system is turned into a geopolitical tool. A tool so powerful that some policymakers began calling it the financial nuclear option. For decades, SWIFT was just infrastructure, like roads, like ports, like telephone lines. Nobody talked about it, nobody feared it. Then governments realized something. If access to the global financial system is essential, then denying access can become a weapon. And not just any weapon, a weapon capable of damaging an economy without firing a single shot. The first major demonstration came in 2012. Iran. At the time, Western governments were trying to pressure Tehran over its nuclear program. Sanctions were already in place. But they wanted something stronger, something that would hit the economy itself. So Iranian banks were disconnected from SWIFT, and the consequences were immediate. Selling oil became harder, receiving payments became harder, international trade became harder. Nothing physically disappeared. The oil fields were still there, the customers still existed, the demand still existed. But the financial connections linking Iran to the rest of the world had been severely damaged. Imagine trying to run a modern business while your email suddenly stops working. You can still make phone calls, you can still send letters, you can still communicate, but everything becomes slower, more expensive, more complicated. Now scale that problem to the level of an entire country. That's what financial isolation looks like. And then came Russia. When Russia invaded Ukraine in 2022, several major Russian banks were disconnected from SWIFT as part of a broader sanctions package. Once again, the message was clear. Participation in the global financial system was not guaranteed. It could be withdrawn. And suddenly, governments around the world began asking a very uncomfortable question. What happens if we're next? Because here's the reality. The weapon isn't SWIFT itself. SWIFT is just the visible part, the headline, the symbol. The real power comes from something much larger, the combination of the dollar, the correspondent banking network, chips, financial surveillance, sanctions enforcement. SWIFT simply happens to sit at the intersection of all of them. That's why being disconnected carries such weight. It's not just losing a messaging platform, it's losing frictionless access to the financial ecosystem surrounding that platform. And the effects aren't limited to governments. They reach ordinary people. A business owner unable to pay a foreign supplier, a manufacturer unable to import components, an exporter unable to receive payment, a family struggling to move money across borders. Sanctions may target states, but economies are made of people, and people inevitably feel the consequences. This is why policymakers often describe financial sanctions as an alternative to military force. In theory, they allow countries to apply pressure without resorting to war. But they also reveal something profound about the modern world. Power no longer comes only from controlling territory. It comes from controlling access to markets, access to capital, access to financial infrastructure. And perhaps the clearest example of that power wasn't Iran, and it wasn't Russia. It was one of America's closest allies. Because if you really want to understand how much influence this system creates, you need to look at what happened to a French bank. A bank so large that it thought it was untouchable. It was wrong. Most people assume financial sanctions are designed for enemies: Iran, North Korea, Russia, countries already in conflict with the United States. But the most revealing story isn't about an enemy, it's about an ally. France. Specifically, one of France's largest and most important banks, BNP Paribas. In 2014, the bank found itself facing a nightmare. American authorities accused it of helping process transactions involving countries under US sanctions, including Sudan. Now, here's what makes the story remarkable. BNP Paribas wasn't an Iranian bank. It wasn't a Russian bank. It wasn't a Sudanese bank. It was a French bank, operating under French law, in a sovereign country, an ally of the United States. And yet, Washington had leverage, a lot of leverage, because somewhere along the way, many of those transactions had touched the dollar system. And once a transaction touches the dollar system, American regulators gain a powerful argument. This falls under our jurisdiction. The result was devastating. BNP Paribas agreed to pay nearly $9 billion in penalties. 9 billion, not million, billion, one of the largest financial fines in history. But the fine wasn't the most frightening part. Money can be earned back. The real fear was something else: losing access. Because behind the scenes, American authorities had another weapon available: the ability to restrict a bank's access to critical parts of the dollar clearing system. And for a major international bank, that's not an inconvenience, that's an existential threat. Imagine running an airline and suddenly losing access to airports. Imagine operating a shipping company and losing access to ports. That's the scale of the problem. A global bank without reliable access to dollar infrastructure becomes dramatically less useful to its clients. And banks understand this very well. Which is why financial institutions around the world spend billions of dollars every year on compliance. Not because they admire regulation, not because they enjoy paperwork, but because they understand the alternative. The lesson of BNP Paribas spread far beyond France. Banks in Europe saw it, banks in Asia saw it, banks in the Middle East saw it, and they all reached the same conclusion. The United States didn't need to sanction every bank, it only needed to make an example of a few. The message would travel on its own, and it did. This is what makes financial power so unusual. Traditional power often relies on force. Financial power relies on incentives. A bank looks at what happened to BNP Paribas and adjusts its behavior long before any regulator contacts them. No threat is necessary. The possibility is enough. And that's why, today, banks from Beijing to Dubai often spend as much time thinking about American sanctions as they do about their own domestic regulations. Not because America owns them, but because America sits at key points of the infrastructure they depend on, which raises an obvious question. If the system is this powerful, why wouldn't countries try to build an alternative? And that's exactly what some of them have been doing. If there's one rule that appears throughout history, it's this. Whenever a system becomes powerful enough to control others, someone eventually starts looking for a way around it. And that's exactly what has been happening in global finance. Because countries like China and Russia have been watching the same events we've just discussed. They saw what happened to Iran. They saw what happened to Russian banks. They saw what happened to BNP Paribas. And they reached a simple conclusion. If access to the system can be withdrawn, then dependence on the system becomes a strategic risk. Not today, perhaps, but someday. And when you're planning decades into the future, someday matters. Russia was among the first to act. After tensions with the West escalated in 2014, Moscow began developing its own financial messaging network. A domestic alternative designed to keep Russian banks connected even if access to SWIFT became restricted. The system was called SPFS. At first, many observers dismissed it. The network was tiny compared to SWIFT. The scale wasn't even remotely comparable. And that criticism was fair, but that wasn't really the point. Russia wasn't trying to replace SWIFT overnight. It was building a lifeboat. Something better than having no alternative at all. China was thinking along similar lines, but on a much larger scale. Beijing understood something important. The world's second-largest economy was still heavily dependent on infrastructure, ultimately influenced by the world's largest economy. From China's perspective, that wasn't just an economic issue, it was a national security issue. So China expanded CIPS, the cross-border interbank payment system, a network designed to facilitate international payments using the Chinese yuan. Now, to be clear, CIPS is not replacing SWIFT, at least not today. In fact, many transactions within CIPS still interact with parts of the existing global financial architecture. But the direction of travel matters. The goal isn't necessarily to destroy the current system. The goal is to reduce dependence on it. And that distinction is crucial, because most countries aren't trying to overthrow the dollar tomorrow. They're trying to avoid being trapped by it in the future. Think of it like a homeowner buying a backup generator. The purchase doesn't mean they expect the power grid to collapse next week. It means they don't want to be completely helpless if it does. That's how many governments increasingly view alternative payment networks, insurance policies, not replacements, at least not yet. And this is where an interesting paradox appears. The more powerful America's financial tools become, the stronger the incentive becomes for other countries to build alternatives. Every successful use of financial sanctions demonstrates American power, but it also reminds the rest of the world how vulnerable they might be. In the short term, that strengthens Washington's position. In the long term, it may encourage fragmentation, multiple payment systems, multiple financial networks, multiple spheres of influence, a world where money moves through several competing channels instead of one dominant system. And if that happens, the global financial order that has existed for decades could begin to change. Not overnight, not dramatically, but gradually. The same way most historical shifts happen. One connection at a time, one institution at a time, one transaction at a time. Because the biggest threat to a dominant system is rarely a sudden collapse. It's the slow construction of alternatives. And that brings us to the final question. What happens if the world eventually stops agreeing on a single financial network? If you enjoy understanding global chaos in slightly less chaotic ways, you know what to do. Now, let's keep going. So where does all of this lead? What happens next? Because despite all the headlines about sanctions, de-dollarization, and alternative payment networks, the truth is that nobody really knows. What we do know is that the current system sits at a crossroads, and from here there are three plausible paths. Scenario 1. The empire endures. This is the simplest outcome. The dollar remains dominant. SWIFT remains dominant. CHIPS remains dominant. Alternative systems continue to exist, but never reach critical mass. Most countries decide that the benefits of staying inside the existing system outweigh the risks of leaving it. After all, network effects are powerful. Trust is difficult to build, and replacing decades of financial infrastructure is incredibly expensive. In this future, America keeps its position at the center of global finance, not because everyone loves the arrangement, but because there is still no better alternative. Scenario 2. The financial Cold War. This future looks very different. The world slowly divides into competing financial blocks. One centered around the Western financial system, another increasingly centered around China. Countries begin maintaining multiple payment channels, multiple settlement networks, multiple reserve assets, not because they want to, because they feel they have to. The result is a world that becomes less efficient, more complicated, more expensive, but also less dependent on any single center of power. In other words, more resilience, less integration. Scenario 3. The multipolar money world. The most unpredictable outcome, a future where several major financial networks coexist. No single gatekeeper, no single financial superhighway, no single referee. Technology accelerates the shift. Digital currencies mature. Alternative settlement systems expand. The monopoly of financial infrastructure gradually gives way to competition. That may sound appealing, but there's a trade-off. The current system may concentrate power, yet it also provides coordination, and coordination is valuable, especially when trillions of dollars are moving every day. A world with multiple competing systems could create greater freedom. It could also create greater confusion. History suggests we often get both, and that's why nobody should assume the future is automatically better or worse, only different. When people think about power, they usually picture things they can see. Aircraft carriers, missiles, armies, flags, borders. But the most important forms of power are often invisible. The roads, the cables, the networks, the infrastructure, the systems everyone depends on and almost nobody notices. SWIFT is one of those systems. On paper, it's just a messaging network. A technical tool created by banks to communicate with each other, nothing more. But over time, that simple messaging network became connected to something much larger. The dollar, correspondent banking, chips, sanctions, global trade, national security, geopolitics. What began as financial plumbing became a source of geopolitical leverage, not because it was designed that way, but because enough of the world became dependent on it. And perhaps that's the real lesson. The greatest power doesn't always come from controlling resources. Sometimes it comes from controlling access to resources, not from owning the game, but from owning the board. Because in today's world, money isn't just wealth, it's information, it's connectivity, it's permission. And the countries that influence those permissions influence far more than finance. They influence the global economy itself. So the next time you hear about sanctions, international payments, or a country being cut off from the financial system, remember, the story isn't really about money moving around the world. It's about who controls the messages and what happens when the rest of the world decides it no longer wants to depend on them. So here's the question. If the global economy depends on infrastructure heavily influenced by a single power, does that create stability for everyone? Or dependence on that power?